is supernatural body of global tax cooperation. Tax information exchange, TIE, and domestic tax treaties, U.S. taxation of foreign income to U.S. person, U.S. taxation of U.S. income on foreign person, U.S. taxation of foreign entities, U.S. beneficiaries, foreign processing of other entities, tax avoidance, tax evasion issues, and fact. Okay. Did he give something? Did he leave something? That's all he done? Now he was supposed to do an overhead, and frankly he said he was busy, so I don't know what happened. He sent me the wrong overhead. So I had to call him and say that's the wrong one. So anyway, I think he's kind of pressed for time, but I think we have enough time to get something out of the way. As you know, the topic is, it said, international taxation. From an international taxation perspective, there's always a country that will be referred to as the base country for which we are making international practices or referring to from an international perspective with regards to international practices, international transactions, the way two countries act towards each other. Now, as you know, you will find the U.S. government, or the United States, is the largest economy in the world. As you get your hand out, you will see why the best reference will be the U.S., because you will find that there are billions and trillions of dollars of international transaction that occurs between the United States and Europe, the United States and Canada, the United States and the UK, the United States and Japan. And so the best, I suspect why they put it in the syllabus, is to have U.S. as a comparison. And for the most part, you'll find U.S. is driving a lot of these international taxation issues. And so with that, let's begin to look at, okay, what the U.S. system composed of. For some of you, I know you may be accountants, so you'll be familiar, and then there's some of you who suspect are not accountants, so you may not be familiar with some of these terms that you will see throughout the literature. Here, the handout I gave you is basically the determination of an individual or a corporation tax liability. And the tax liability will be the amount that that individual will owe to the U.S. government. Our first one will be an income broadly defined or income broadly received. And what this is that every conceivable type of income an individual or a corporation may have, it will have to be included in this section. Every conceivable income, with all truth on the table. Okay, everything on the table, no one is BSing anyone, this is what I have. Okay. Now what I find is that there are a lot of, normally, and you accountants who are here can help me out, which rhetoric in the market, more so from a quantitative perspective about how much taxes are involved in the U.S. and how people will be making. But what I would like us to think about when we make these statements are what are the prices that are in the United States versus other countries. And so I said that with regards to, when we look at the next line, it says exclusion. That is income that is not subject to taxation. And so in the first line, you would have included every conceivable income that you would have. And then the U.S. government, being through the Congress, through the executive, and through the judicial, because they all, I think Sammy was here the other day and spoke to you about how the laws are defined, how the laws are determine how to come up with it? Well, between the Congress, between the executive branch headed by the president, and then the judicial branch. And so we may say, why the judicial branch? Because what happens is that Congress writes the laws. The president puts his signature on the laws. But these laws are not fully defined. And so to define what the laws actually mean, they have to go to court. And so the court at that point determines, okay, this is what it means. Okay? And so it's not Congress in that instance, or the president in that instance, who determine, for instance, in this land, what are exclusions. It's the judicial system that determines that. Okay. And so this will reduce the amount of your base that you will use to determine your tax. And then we have something that's called gross income. That is, income that is subject to tax. Now that line is misleading because depending on the individual, you may have other items that further reduces your tax base as it relates to the US. And so that's gross income. And so next we have less certain deductions, which is usually referred to as deductions for AGI, or he says for AGI. Now, what it is, these again are amounts that the Congress has specifically excluded from being taxed. Okay? And so you've determined your gross income, and then you've determined these amounts that the Congress says, okay, we're not going to tax these specific items. To give you an idea of what that means, there's a list of items, and as you know, this is an international tax, but I'm just trying to give you the premise for which we are. For instance, if we were to go back to exclusions, what will be the amount of, or what will be the items that will be excluded from exclusions? 1, accident insurance proceeds, annuity like when you have pensions, bequests, child support payment, cost of living allowance for the military, damages for personal injury and sickness, gifts received, group term life, that is for coverage, the premiums on that, coverage up to $50,000, inheritance, interest, meals and lodging, military allowance, minister dwelling, road, railroad retirement, scholarships and grants, social security benefits, unemployment compensation, veteran benefits, and the like. These are items that are specifically excluded from being taxed. Now, under the items that will come under deductions allowed for AGI, we'll have things such as alimony, annuity. Now let's just take alimony for example. In other words, you as an individual who are married and now you find yourself divorced. You've paid your wife, or you're paying your wife monthly or an annual amount for alimony. And so as a result, it means that this income is not available for you. The question is now, how should that be treated? Well, the Congress say we'll reduce your tax base by the amount of the alimony for which you're going to pay. And only fair enough, right? Because you don't have access to that money. And when we say you don't have access to that money, that the money's there doesn't become a part of your residual income. Okay? So there's no access. In addition to other partial lists, we'll have things such as awards, pay, back pay, bargain purchase from employers, bonuses, breach of contract damages, business income, clergy fees, commission, compensation for services, prizes, professional fees, punitive damage, embezzle funds, dividends, and the list goes on and on and on. Even included in that is gains from illegal activities. Okay? Some of you may find that hard to believe. And so that will give us a figure what we call AGI, or adjusted gross income. Now, under that we have an amount, yeah, sorry.
The list you're reading from, we're going to get that, or that is in this?
No, you're not going to get this list because this is really not international taxation. I'm just giving you the 2 items I need to come to on this formula. One being deductions, and second being credits, that you need to know how it fits into the entire program because it will be referred to over and over again. You see what I'm saying?
Okay.
And so as a result of that, I need to develop your knowledge base so you have a greater appreciation when I get into the meat or the crux of things.
But
Yes.
I would like to.
You would like a
know-
copy?
Yeah, to know the different types that would be deducted.
That's for the US, right?
This is
Yeah.
just for the US, so you want that? Okay, I will ask, you want it now, today, or later?
Yeah, just for information.
If I read it on the board, it's gonna be, rather onerous, because it's a long list, some 50-something items in one instance, some 30-something items in another, so it'll be rather long. Okay, but I'll give you a copy, okay, for next week, or when we take a break.
Yeah, because we still need more copies of the handout.
Okay, I'll inform you. You said something?
Yeah, no, is there a general definition of exclusion? Given this, can you say exclusion, anything relating to, say, bodily injury or insurance? Is there an overall definition?
Okay,
for
see,
exclusion?
this is why, I have to give you these, this development. Okay, I will give you the theoretical definition, and then I'll break that definition down for you, okay? All right. I didn't know you guys would be that interested. The definition that I'm here with is not going to be sufficient to give a lot, so I'll have to give you a more broad-based definition. Okay?
Could I just say this?
Yes, ma'am.
I know taxation is a topic that you would study for a very long time. The minister mentioned how many years he was studying and involved in taxation, right?
Uh-huh.
But I would like to leave this course having a sound knowledge, And so I know the US taxes, volumes and volumes of, work to, right? And I don't want to go there, but at least having a sound basic knowledge.
You want a sound appreciation for it.
Yeah, for tax.
I can give you
Because
that.
I know we're not gonna go into the nitty gritties and the granular
Mhm.
part. But
Okay.
at least,
Okay. Good.
it don't really relate to my job per se, but I would like from a citizen
To
perspective,
understand it.
yeah.
Okay. So, we should have this. From a definitive perspective, it says the Congress has chosen to, keyword here, exclude certain types of income from income tax base. And so when we begin to talk about the tax base, if you go to the bottom of the formula I gave you, are you there? Where you see taxable income, double line. You see that item? That's the tax base. That's the amount for which your rates will be applied. Now, the rates that exist in the United States range from 10% to 35%. And these comes in various tiers. Okay, now, so what I mean by when I say various tiers? Well, first, this is so much work, ma'am. I can spend just time and time, so I'm gonna try to move a little fast, okay? What happened is that in the United States, there are certain categories under which an individual falls if you're dealing with a single individual. I mean, not single, if you're dealing with a human individual, okay? For instance, you have the individual who's single. So that's a category, for instance, with an average 19, 20, 21-year-old before, not married or anything of the sort. Do we agree? Next, we have individuals who are married. But the married status falls in two categories. You can either file jointly, that is the husband and the wife, or you can file separately. For instance, your money is your money, My money is my money. Do we agree? Let's not mix it up. Do we agree? Now, I must say that there are penalties as a result for those individuals who file separately. Okay? What they will find is that their deductions will be less. Okay? So you have three categories I've mentioned so far. The single individual, the married individuals who file jointly, and the individuals who file separately. Are we on board? Yes. And then we have, yes?
No, I'm sorry.
And then we have what is called the head of household. Okay? So those are basically the four main categories. But there is a fifth category that is called the surviving spouse. Now remember, we're still talking about the individual. Agree? So we have a fifth category that is called the surviving spouse. And what the surviving spouse is about is that if you're a surviving spouse, evidently at some point you were married. Agree? And so either one of the spouses have died. And as you know, it's easier to operate in harmony, I must stress, with two incomes rather than one income. So the Congress, in its generosity, says, for an individual whose spouse has died, for 2 years, they can continue to file marriage filing jointly. So why? What does that benefit them? But what you will find is that these deductions, for instance, when I was referring to the AGIs, the deductions are larger for marriage filing jointly as opposed for the single individual or the married filing separately. Okay? And so you would want that. Okay? So just to a large extent, the marriage filing jointly doubles the deduction for a single individual. Remember what this deduction is doing. This deduction is reducing the amount of your base which will be taxed. And so what you want to do is you want that base to be as small as possible. Okay? The more you can take away, right, the less your taxes will be. Okay? And so for instance, you've heard about loopholes, right? I'm certain you hear in the news, okay, there's this loophole Congress is trying to close. Why? Individuals who are very astute, right, and we'll be getting into these other things, this go on and on and on. You'll find that, for instance, a part of your subject that you'll do in the 3 times with me will be tax evadance and tax avoidance. Tax evasion and tax avoidance, do we agree? So what the loophole is a tax avoidance mechanism. Okay? Now, tax avoidance is legal. Tax evasion, on the other hand, is illegal. Okay? So when you are trying to avoid taxes, it's like avoid an accident, right? You are in your interest to avoid an accident. Because if you do get in an accident, what happens? It's going to cost you. Agree? And so that's what tax avoidance is all about. How will it cost the individual? Well, it will cost them in more taxes. Okay? Alright, so we have those 5 categories, but I say remember there are really 4 bases for which tax is.
Can you repeat that? Married with separate accounts.
Single, married filing jointly, married filing separately. Head of household. And then we have surviving spouse. And remember, surviving spouse really comes about where an individual spouse has died, and for 2 years they can continue to file as if they are married. Okay? Yes, sir.
Just an aside, the UK will discriminate if a spouse is male or female.
Well,
Notice,
the term is neutral gender. It says spouse.
Yeah, yeah.
Okay?
Yeah.
It says spouse, so therefore it works on either side. Okay? What else? So, that'll give you that. So we now back to the exclusions that Mr. Pindler asked us about in terms of understanding what is an exclusion. And I read it where I talked about the Congress and I ended up talking about the tax base, right? And I end up referring to the various classifications under which each individual will fall. Okay, now, exclusions. An exclusion is to, or affects your taxes to an extent where in actuality, you're not taxed on it at all. You remember the first item we said is income broadly defined. Okay? The income broadly defined is where you will put your exclusions also, right? And then you take them out, so it has a zero effect. So for instance, let's say that you had an income that will qualify for an exclusion that is worth, say, $5,000. You will have to include that in your income broadly defined. Okay? However, you would be entitled to an exclusion for that $5,000, which means it's in the income broadly defined and it's out in the exclusions. Okay? Now, here again, as I said, as it relates to the exclusions, there are any number of them. On the list itself is probably about 30. Each of these exclusions has specific rules surrounding how one qualifies. So that itself, for each of those rules, you'll find, let's say, anywhere from a half a page to about 3 pages of literature that defines how you will qualify for an exclusion. You get the idea now? And like I said, it's about 30 of them. Okay? So, as you can see, for me to go into depth in them itself, as a matter of fact, if I may say, when we began to talk about exclusions and when we began to talk about deductions in itself, that covers more than half of this book, this size. Literally. You get it? For instance, you will find that we have what is called inclusions and exclusion. Inclusions and exclusions has an individual chapter within themselves, and the pages on each of those chapters is probably somewhere between 30 to 40 pages. Okay? All right. So here we on the exclusions itself, right? And so I'll give you the list, but like I said, these are amounts. Just to go back, let me see if I can assist you in an efficient manner in the determination of, say for instance, one of the exclusions is, for instance, meals and lodging. If furnished by the employer for the employer's convenience. It's an exclusion. In other words, what you will find in the United States is that every dollar you get, and the dollar doesn't necessarily mean that you actually have physical amounts that you can deposit in the bank. If I said it another way, it's every advantage that you would get or you would receive has the potential of being taxed. So if your company gives you free meals, depending on the amount, that's tax. And so what do you do, for instance, if your company provides you free lunch for 5 days a week, and so you say that 52 weeks, 52 weeks, right? You will have to determine, okay, how much does it cost per day versus times how much it will cost per week and how much it costs per month, okay? Then you determine times 12 how much it will cost you per year, and that amount is included in income broadly defined. So you notice you haven't received a dollar. If you remember, for instance, just to take this back, an item in it you'll have as gift. When several years ago, individual appeared on Oprah Winfrey's show, and they all received cars. You remember, and a lot of those were household moms. They couldn't afford the car even though the car was given to them free. Why couldn't they afford the car? Because the average price of the car was about $18,000. Which means that their income increased by the value of the car, which was $18,000. And so now you have to pay taxes on this $18,000. Yes, ma'am?
What about the homeless receiving food from soup kitchens?
Okay. What we have in the United States are charitable organizations. Charitable organizations, depending on if it qualifies as a charitable organizations, they would be exempt.
So the person's receiving the benefit would not have to pay taxes on it?
That is correct for more than one situation. what happened is, who's going to police what they receive if they are homeless individual? Who's going to police that? You see what I'm saying? Where, if we refer to the individuals receiving a gift on Oprah's Winfrey Show, there's a list of persons who receive the car. They have to register these cars. You get it? So they can find out who you are. You get me? It's from any number of sources. They go to Oprah and says, first of all, you don't get an Oprah show unless you get an invitation. Agreed? You just don't walk in as if it's a general auditorium. You have to get an invitation, which means they will Oprah, please furnish a list of individuals who were here on such and such a day. Agreed? Their addresses will have to be known, and so the IRS can find out okay, who these individuals are.
Our company gets to deduct it as a charitable.
Pardon?
Does her company get to deduct it as a charitable deduction?
Well, it wouldn't be a charitable deduction. She can, there'd be any way, not necessarily a tax. The question is that may be an expense, such as an advertising expense or promotion expense. So yes, her income would be reduced, or her tax base would be reduced by the amount of what she gave up, because it is a promotion. Now, there's a situation here. It was a combination between she and General Motors. Okay? It didn't, because she had to do the car, so okay, let's negotiate how much you gonna let me get these cars for. So evidently it'll be a little cheaper a month. Okay? So General Motors get a part of it, she gets a part of it. At the end of the day, for her, it's not what the value of the car is, it's the price for which she paid for the car. Okay? And then for General Motors, it will be the amount for which they reduce the cars to her for.
So the individual accepting it and their income is way below, that means they cannot accept the gift.
I wouldn't say they cannot accept the gift. What Oprah ended up doing, as you know with everything, there's a net effect in terms of the taxes that you pay on it. So what Oprah had to end up doing is really paying the taxes for them. And so, yes, okay, so you may say, okay, but that's another benefit for which they receive. But she didn't just pay the taxes for which they were supposed to pay, she paid the taxes on the taxes.
That could go on and on.
It could go on and on. So at the end of the day, there's it would be called a diminished effect. And a diminished effect means very, very small. Okay?
But all of that reduces the tax base.
Yes, all of that would reduce her tax base. Now, the only way, you remember, it wouldn't reduce her tax base if it's, I don't want to say if it's an illegal event, but if it's contrary to public policy, that would be the only way you won't be able to get a deduction for it. Contrary to public policy. Okay, for instance, well, for instance, an individual such as Exxon, right, who have these oil spills and found to be negligent, they are fined by the government, right? There are two types of financials. There's your financials as it relates to, from an accounting perspective, and there are your financials as it relates to a tax perspective. On your financials as it relates to a financial perspective, for instance, GAAP, or generally accepted accounting principle, right, they will be able to reduce their income by the amount for which they're paying in the fines and penalties. When it comes to taxes, however, they won't be able to reduce their tax base by their fines and penalties because it would be contrary to public policy. How? Well, they're reducing their taxes, and so therefore they're being rewarded as a result of the negligence for which they've done. Okay? All right. Okay, so exclusions. Remember I said meals and lodging. So the question is, how do one qualify? Well, one, it has to be provided on the premise of the employer. That's the first thing. Okay, it should be provided on the premise of the first thing. Where is the next place for them to eat? Is there somewhere across the road for them to eat? Or is it that if they want to leave to go to get something to eat, it will disrupt their very job because their job requires their presence? You get the idea? And so this can go on and on and on. And so, when it comes to that, so they said, okay, we'll give an exclusion for it. Who gets the exclusion, right? No, you will find that the tax law moves between the personal and the company or the corporations, right? In this case, the company, in this case, the individual, they are not allowed to include it, because they include it in gross and they are in income broadly defined, okay? But it's excluded, right? Therefore, reducing their gross income and subsequently reducing their tax base. Now, there are several income terms that we will use. Income, which is broadly defined, then we have gross income, and then we have taxable income, and then we have adjusted gross income. So really 4 items. So here, anyway, does that help? You guys need students? Okay. All right. So next we have certain deductions, usually referred to as deductions for AGI. Okay. And so basically, what the Congress says, to give you the theoretical definition again for income for AGI, deductions for AGI. Individual taxpayers have 2 categories of deductions. One, deductions for adjusted gross income, and deductions to arrive at adjusted gross income. Deductions from adjusted gross income. And so we have for AGI and what we call from AGI. 2 different categories. Now, which one would you want? You want for AGI and not from AGI. Okay? Now, deductions for adjusted gross income AGI is sometimes known as above the line because of on the tax return. They are taken before the line. And so what is the line? Well, you see a line that's called adjusted gross income. Okay? We call it the line because it's like demand. Not demand, but demand, M-A-N. When someone say you demand, what does that mean? You're the breadwinner, but more specifically, everything circles or centers around you as a person. Okay? But what you will find that in the determination of taxes in the US, a lot of the calculations will be based on what AGI is. For instance, it will have to be 2% of AGI, 10% of AGI, you get the idea? Okay? 25% of AGI, 20% of AGI, depending on what specific, what they are talking about specifically. Okay? So everything is centered around it. So in other words, to determine what it is, you now have to go to see what your AGI is. Okay? Yes, ma'am?
Do you have any more?
Yeah, we're looking at the formula. Now, like I said, some of you are accountants, but some of you are not accountants, and some of you would have studied this. But I know before you came in, I think you're an accountant. Okay. Some individuals asked me to be more detailed about what certain things mean. Okay, so I don't want you to say, okay, this seems repetitive in any way. And so a lot of things will be around AGI. And one of the items as it relates to AGI will be, here specifically. Okay, but anyway, let's go to the list itself where it says partial list of sorry. Okay. Okay, AGI. What are on the list as it relates to AGI? Expense incurred in the trade or business. Unreimbursed moving expense. Contribution to traditional IRAs. Fees for college tuition. Well, let's go to expense incurred in the trade or business. And notice we're talking here about AGI. Do we agree? We said there's a difference between AGI, for AGI and from AGI. Expenses as it relates to a business. Well, what happened? Let's say, for instance, super value is in the United States, okay, and being taxed under the U.S. laws. So super value, we see people going there every day, and you would suspect super value makes thousands and thousands of dollars. Do we agree? Okay. But super value have a cost related to his income that he would eventually determine. Those costs would be as it relates to what he paid for the items that he's selling. Agree? His salaries, his PEC, his water and sewage. Do we agree? Well, the tax law has what is called the return of capital doctrine. And what do we mean by capital? The amount that you have actually put in it is the amount the tax laws says that you can take out before you determine the amount of your taxes. Okay? Or before you arrive at your taxable income. Or, in this instance, your AGI. Whatever your cost would have been. Okay? So they will take it out. So that's an AGI or 4 AGI deduction. So as you can see here again, super value won't be taxed on what was called revenues. Agreed? Super value will be taxed on revenues less expenses. Okay? That super value is right. The government cannot make super value. Remember we said suppose super value is in the US. The government can't do anything about that. If the government take him to court, or Mr. Roberts to court, the court will tell him, hey, this capital doctrine actually came from us. It's the court who determines, okay, what an individual should be taxed on, or when is an item a taxable item in terms of when an item should be excluded or not. Okay? Alright, so our next item will be, like I said, adjusted gross income, which we say is the MAP. So we have now the lesser of, the greater of certain personal and employees deduction, which is usually referred to as itemized deduction. And then we have here what is called standard deduction, including any additional standard deductions. And so what is that? Well, the first one is for the from AGI deduction. Remember I listed the expenses as it relates to business, right? So that was for AGI. Now we have from AGI. From AGI includes personal living expense, including any losses on the sale of personal use property, hobby losses, life insurance premiums.
Sorry, hobby losses?
Yeah, hobby, as in when you have a hobby, I like reading. Okay? If you need me to explain it, I can explain it.
No, I just want to be clear.
Okay. Expenses, incident to jury, gambling losses, child support, fines and penalties, political contribution, certain passive losses, funeral expenses, expense paid on another's behalf, and capital expenditures. Now, those items are what we can deduct for AGI. The only thing with those items is those items are limited to the extent that whatever the total amount of them are, remember, yes ma'am?
From AGI.
These are from AGI.
Right.
The first one I said was for AGI.
Right, so this
This is
first
from
one.
AGI now.
Okay.
Okay? With this, like I said, the only problem with this one is that, first in most instances, no one would qualify for all of this, in very rare few circumstances. That's the first thing, right? So this will be contingent upon what your AGI is. Why? Because the only amount that you will be entitled to get a deduction for is the amount that exceeds 2% of AGI itself. So let's say you had one item in there which was a passive loss, and the passive loss itself, let's say, was $15,000. Agree? And let's just say, for the sake of things, your AGI was very large, and 2% of AGI is equal to $18,000. It means now, even though you've experienced a loss that comes under from AGI, you would not get a deduction for it. In the terms that they use, it's to the extent of 2% of AGI. And when it says to the extent of AGI, it means wherever that amount starts, only that which exceeds the amount, for instance, the 2%, like I said, suppose it's 18,000. For instance, if your passive loss, for instance, was 19,000, then in this case, you will be able only to take a deduction for 1,000.
Oh. Okay.
You got it? Make sense? Okay? So that will be an example of that. Now, however, this for AGI is an either-or situation. You can either use the first line, when we use the way see or the second one, depending on which one is more. And so notice on the second one, we have standard deductions. Does everyone see that? Okay. And so standard deductions is an amount that the government has allowed each individual to take. And notice I said individual, right? And I didn't say company, because companies do not have standard deductions. So it's an amount that the government allows each individual to take. Now, the standard deduction will come under the various filing statuses. For instance, I want to give you some figures. Okay. For instance, standard deductions for a single individual for 2013 was $6,100. That's, remember, you have the 5 categories, right? Which effectively comes to 4, because you remember it's just an extension, right? So if you're single, you can take a standard deduction of $6,100. In other words, when you see your gross income, you've already reduced it by, depending on if you have any exclusions or if you have any 4AGI. Do we agree? And now you can reduce your potentially taxable income by $6,100 if you're single. Or you're single under single filing status. If you're married filing jointly, you can reduce it. Your standard deduction will be $12,200, which is normally double what the single is. Okay. But the married filing separate only receive a standard deduction of the $6,100, and the head of household receive a standard deduction of $8,950. Now, note it says also any additional standard deduction. Well, there's an additional standard deduction if you are old. For instance, you're over the age of 65 and you are blind. So if you're old and blind, you have an additional $1,100 for which you can take for each of those. Okay? And let's say a single individual was old and blind. So now their standard deduction will be $2,200 plus the $6,100 for standard deduction, which will be what? Something like $8,300 or something like that? Okay? So that's the amount for which their taxable income will be reduced. Now, like we said, it's either or. Do you get that? So that's the standard deduction that everyone is entitled to take. We also have what is called the personal and dependency exemption. Do you see that? You see that? Okay, so the personal and dependency exemption is awarded to each individual who, what should I say now, is, what should I say?
You're taking care of who is dependent on you.
No, I'm trying to get the specific definition, because the fact that you work in the U.S., you don't necessarily qualify for a personal dependency exemption. Okay? So it's for those individuals who are permanent residents, for instance, or citizens of the U.S. Okay? Note it has that's personal, and you're working. So the personal will refer to the individual who is filing the return. So if you're filing jointly, you will have 2 personal exemptions. Agree? Now, the dependency will be for those individuals who you are supporting. Now, here again, everyone doesn't qualify in terms of support. There's 5 categories for which an individual will have to go through to determine whether they qualify as a dependent. Okay? And then even if they don't qualify under those, then we have another category which says the relationship test. And so you may qualify under that specific category. Okay? Now, the fact that, for instance, you send your 10-year-old daughter to live in the US with your, say, sister, who is now of permanent resident status, so therefore qualifying, doesn't mean that she is a dependent. The dependency is normally awarded to kids from the US, kids from Canada, and Mexico. It's normally limited to individuals from that category. And then, but like we said again, there is also a relationship test for which they may qualify. Okay? First of all, I didn't mention it. First of all, it's the support test, let me say this, and then it's the relationship test. So the fact that you're supporting someone, they still have to have certain categories in which they must qualify. Okay? So let's say they don't follow, let me give you an example of how this would work. Say a qualifying child. A qualifying child must meet the relationship test, the abode, age, and support test. The relationship test in terms of what you are to the individual. The abode test will be in terms of who you're living with. For instance, imagine individuals having joint custody in the United States. Agree? Individual having joint custody, the question is now, who should get this dependency exemption? The individual who would qualify or get the dependency exemption would be, in most instances, who the child lives with. Now, it doesn't mean that, here again, that they will have to get it. It can still be gotten by them if, for instance, say the wife, the child living with the wife, she has a written statement that says she allowed her husband to get it. Okay? Now, for him to qualify again, he must be providing more than 10% of a support. Okay? There's also something that's called the multiple test, where, say you have a mother, and all of her kids are supporting her, and say she has about 6 kids. So everybody's giving a little something. So the question is now, who should get the dependency test, the dependency for this individual? Well, the individual who qualified is anyone who provides more than 10%. That's the first thing. So if you only provide 5%, you don't qualify. And then all of the other kids must sign a written declaration that we allow this person to get it. So one will get it 1 year, one get it the next year, you can come up with that. Okay. So anyway, that's the dependency situation. And note that will bring us to what is called taxable income. Now, and then so this amount will be determined based on the tax rate for that particular year. Now, the tax rate don't necessarily change frequently, except for there have been a lot of changes as it relates to capital gains. So the tax rate will range from 10%, 15, it'll be 10, 15, 25, 28, 33, and 35%. Okay? Now, these comes in tiers. 10% at a certain rate. Anything above that, but not higher than another rate. For instance, let's look at individual filing singly. Individual who files singly, the first 8,700. Notice this is taxable income now. The line that we have there that says taxable income. So you've already taken away all your deductions. Do we agree? So if your taxable income is $8,700, and this is from a single category, you pay 10% taxes on that. For instance, this person's tax will be $870 US dollar. The next rate will be $35,000. So if you're making anywhere between $8,701 to $35,350, you will be taxed 15% just in that spot in between there. Okay? And so from $35,351 to $85,650, you will be taxed 25% on that amount in there. Get the idea? Okay? And so we have these, like I said, these different tiers for which the tax will be determined. Now, the part that you will find that is most important to you as it relates to this class is what we call tax credits. And note we said, after we've determined our tax liability, remember the tax liability is determined by the base, that is, that the base is equal to the taxable income, okay, times the rate, okay, you will determine your tax liabilities. So now we have what is called tax credit. So your liability will be reduced by the amount of your credit rate. Okay. So now,
I'm sorry, excuse me.
sorry. Okay.
Just want to make sure, and we're talking about the US.
Yeah.
That's the amount of credit that you owe. You got.
No.
Oh, that's the credit
No.
access that you have based on credit cards and all this stuff.
No. Remember I said this is as it will relate to you, right? There are two things that I need you to have an appreciation for, which is why I brought this, so you can know the effect on the actual tax return in itself. We have what is called credits. But prior to credits, as you see, we have what are called deductions. We agree. Now, what are these deductions, and how does the deductions affect the individual? The deductions affect the individual is limited to the extent of what we call the individual marginal tax rate. And when we say marginal tax rate, what do we mean? Well, you remember I said there's a list of rates that we have, the 10%, the 15%, 25%, 28%, 33%, and 35%. Do you get that? The question is, depending on what your taxable income is, and what rate your last or your highest rate for which you will be taxed on, that's your marginal tax rate. The highest rate for which you taxed. Oh, you got it?
Yeah, the category you fall in.
Yes.
The maximum.
The maximum amount. So let's just say that you have a deduction. This is the deduction for $10,000. Okay? And let's say that your marginal rate is 25%, which means that your taxes on that is going to be what? Not just the taxes, your savings, I should say, is $2,500. That'll be your savings. Now, what do I mean when we say savings? Well, remember, first of all, everything that is in the gross income category doesn't go to the Uncle Sam. Do we agree? For instance, you're making $100,000 and you just take all. So give me all of that. Something like, you know, a kid when they're working and they go to work and the parents say, okay, give me a check, and I put it in the bank. That doesn't happen, right? Uncle Sam says, hey, we only want our share. Do we agree? So let's say that this itself was gross income. The maximum amount Uncle Sam is going to get is what? 25, which means at the end of the day, that's your savings. Do we agree? You still get to take home $7,500 to some extent. Do you agree? That's a deduction. Okay? With regards to a credit says, for instance, your tax is, let's say, $50,000. And let's say you have a credit of $10,000. Your credit will reduce your tax, let's call this liability, by the full amount of the $10,000. In other words, the effect is what we call a dollar for dollar reduction in the amount of taxes you determine to be your taxes. Now when we say determine, if you look at the formula, your determination. Okay? No. So what would you prefer? Will you prefer a tax deduction or will you prefer a credit? That's the question.
You prefer the credit, but I'm trying to understand where the credit is coming from.
Yeah,
You get that?
we can get there. Okay, let me go to the credit, where the credit comes from. Remember, I'll have to go through this itself. or I can go to this, and here again is another list of
Charge
this.
the board.
No, credit.
From your exclusions, you get a credit? That's not it.
Let me say the items that falls under the credit. We have two types of credit. We have what is called non-refundable credits, and we have what is called refundable credits. Refundable credits are your taxes withheld on wages, and then your earned income credit. I'll get back to that. Your non-refundable credit will be credit for child and dependent care expense, credit for elderly or disabled, adoption expense credit, child credit or child tax credit, education tax credit, credits for certain retirement contributions, foreign tax credit, which is a part of this class in itself. You have your general business credit, which includes tax credit for rehabilitation, work opportunity tax credit, research activity credits, low income. Research activity credit is also related to your international taxation, low income housing credit, disabled access credit, credits for small employers pension plan startup costs, and credits for employer provided care. Those are your basic types of credit. Now what are these? These are amounts here again. Let me give you the technical definition. Credit has been introduced as a part of the U.S. tax policy consideration. Listen. The Congress generally has used tax credit to achieve social or economic objectives or to promote equity among different types of taxpayers. For example, disabled access credit was enacted to accomplish social objectives, that is, to encourage taxpayers to renovate older buildings so that they would be in compliance with the American with Disabled Act. So we're talking here about disabled access. If you note that when you go into the US, there seems to always be access for individuals in wheelchairs. Agree? When you go in the bathroom, there's always a large bathroom stall for wheelchair access. Okay? Now think about those buildings that were built years ago. Would they would have had them? No. And so the Congress says, okay, first of all, we have the American with Disability Act, right? In the American with Disability Act, they have what is called this credit as it relates to access of disabled individuals. So if you were to modify your building so that individuals in wheelchairs or individuals who are disabled can get there, you can take a credit for the actual expense that you have actually incurred as it relates to whatever it costs. Now, of course, there is a quotum on that. Okay? And so the question is, so why not allow them to take a deduction? Because the deduction itself means, hey, you know what? I'm still really not I'm still paying for that to some extent. The credit, on the other hand, says, how much did you pay? Say you paid $10,000, right? We'll reduce your tax by $10,000. You get that? Okay? So it's what we call a dollar for dollar amount. Whatever the dollar amount is, that's the amount. With a deduction, no. Your savings is really only the extent of the amount of your marginal tax rate. So what would you prefer? The answer is the credit. The credit is always better. And so what you will find is that as it relates to international taxes, that is taxes as it relates to the businesses that are doing business, or let's say as it relates to businesses that do business both in the US and outside of the US now, you'll find that they have this situation where, depending on the jurisdiction they're in, they're going to be taxed in that jurisdiction, right? But if these are US companies, then what? they are also taxed in the US. And so what does the US government do? Well, it comes back, I'm jumping over the place, I'll just give you an appreciation. There are what are called treaties. Remember those? What we call the ties, right? That the US government forms with these different countries. And the treaties have certain specific requirements in them. And one of the requirements in them is this. Of course, this is in simplistic form. If this individual pays taxes here, because we'll have what is called a primary area of business, which is really where the locale is, right? If they pay taxes there, then the amount of their taxes that they pay, or their liability, their tax liability, will have to be reduced with a tax credit by the amount of the taxes that they paid in that country, so they wouldn't experience what is called double taxation. Okay? And so this is where we are fundamentally going to be going at the end of the day. Okay. And so one other thing I'd like to bring to your attention. You notice when I said credit, I said that there were basically refundable and non-refundable credits, right? And notice I said tax withheld on wages. Notice we said that that is a credit. Because what happens in the US is that they have what is called W-2s. I'm certain you've all heard of it, W-2s. Every individual who works would have a W-2. And the W-2 would be issued by the individual employer. The individual sits down with his employer and says, okay, you remember they have a pay-as-you-go system. Agree? What is a pay-as-you-go? You don't get to see all of your money. The United States money comes out, the United States government money comes out first. Why does it come out first? Well, it comes out first based on the principle of the wherewithal to pay. The wherewithal to pay simply means or states the best time to pay is when you get that, when that money has been earned, right? Do we get it? Let me say it in the Bahamas. Imagine, sorry, deduction. Imagine in the Bahamas, we have an individual who's, for instance, let's say his salary is $3,000 a month, right? And he is now supposed to go, for example, say this was our taxing system, to the post office and pay his taxes to the government. Let's say it's $500. Okay? Now this individual, you know, the government is exclusive of any loans he has. Government knows nothing about that to a large extent. Of course, there are always records, right, in terms of central bank. So somewhere in there, if you have a loan, central bank will have a full slate of, okay, what the total loans are, and somewhere in that they keep breaking out. This is as it relates per bank, then this is as it relates per branch within the bank, and then these are customers within the branch itself. So at some point they can determine, okay? So $500 he got to pay the government, but he got loans, he got kids, he got BEC, water and sewage, and then he likes to travel. And then you got Friday afternoon, like my habit, yeah, I gotta get a drink. You gotta do gas. You think the government will get that $500 every week? And so the question is, so it moves to a situation of when does the individual have the wherewithal to pay, and that is, when he has earned it, it's in the employer's hand, and he only gets the residual of what's left after the government has gotten this. But the employer itself, he just doesn't take out any particular amount. You will have to go to the employer and says, okay, I want you to take out this amount out of each paycheck to send to the government. Now you can't tell the employer don't take out that. You got a problem here. Okay? Now, let's say you tell the employer to take out a certain amount. Say $500. This $500 in itself, right, may still be of a consequence to you. Why? Because if the amount of taxes that you should have sent to the government, that you advise your employer, is, what should I say? Or the amount of taxes that you should have sent to the government is 25%.